Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, the Primary Vision frac spread count, and we're going to go through what's happening with U.S. completions, what's happening with rigs, and then we had a question on what happened with Canadian rigs, so we're just going to touch on that briefly. And then we're going to go through some of the storage that's happened in China, some of the new movements of barrels. And then we're going to look a little bit at European and U.S. data just to give a flavor of what we're going to talk about next week. So without further ado, we have the Primary Vision frac spread count up 1. So we went from 242 to 243. So the addition came in Anadarko. There was 2 there. We lost 1 in what we deem as other. So again, it's more of like a moving day, as More Drilling likes to call it, which I thought was an interesting way to put it. It's just we're not going to see the same type of growth. And I did a whole thread on Twitter, and I did a bigger deep dive in our insights, just looking at what has happened in the past, like where have we been, and what makes the most sense when we start looking at what are rigs doing, and then what are spreads doing. So realistically, we have 490 rigs operational at this point in time, and 243 spreads. So when we look at that, we just want to look at, okay, well, what's normal? Like, what is the normal spread that we should be seeing? And you can see here that we still remain at those highs. Obviously, looking past the February freeze off, but you can see just how quickly there was that recovery in spreads. And that's what we've been talking about since the end of last year, and it accelerated into this year, on where we were going to see that production growth, because this is where the focus was, how do E&Ps minimize decline curves, protect the portfolio, and then spring load into 2021. And it was always going to be on the back of picking up completions, working through DUC counts, and then at Q3, starting to see that rig count accelerate. And we're seeing that right now, where when you look at the spreads, we're starting to level off. We peaked at about 0.5, and now we're just at, as you can see here, 0.4949. And this isn't picking up the new spread count, but it's again, it's only up by 1. I'm sorry, it is picking up the new spread count. So I was trying to delay it so that we could get the best snapshot. So you can see we're right there, where we're going to start to roll over a little bit, but it's not because spread counts are going to go down. It's just they're going to go up at a much slower pace at this point. There was about, let's just say, using rough estimates, there was about 116 spreads that were pulled off to the sidelines. And again, 116, how many of that was retired? How much of that was used for parts? And how much of it can be pieced together to come back into the market? Which is why we start to see that, we're expecting to get to about 255 spreads really by the middle to the end of August, and then see some of that acceleration to about 275. And it's just going to be taking some of this spare capacity and bringing it back into the market. But there's, when we were going back and forth on Twitter, there's been a decent increase in overall efficiencies, if you will. When you look at what the spread has been able to do, the efficiencies have picked up, but here's where it's going to start to flatline. It's not, and if it comes down a little bit, that could be possible. And I would say it's more likely where we have a little bit of a decline in efficiencies, just because you have more newbies on the spreads. You have maybe some older equipment. You're not doing jobs that are as intense, so the production will be a little bit lower. So there's some one-offs and there's some give back when you start looking at that. But next week we want to do a deeper dive of what did Halliburton say, Baker say, Schlumberger, because when we look, Halliburton is talking up a lot about their North America. Schlumberger, Baker is a bit more reserved, but they are seeing growth in the international market, which is what we talked about in segment 3 of the EIA show, where when you look at OPEC, you're seeing the baseline go up because these guys have been investing. They have been looking to increase from brown fields to really stem those decline curves, look at those green fields in different locations, trying to bridge that gap. But they're also increasing their usage of natural gas, which will just slate more crude for the export market. But this is why we want to look at how quickly does this spread really start to evolve. And you can see that the rigs have obviously come back, but just not at the same pace that we've seen the spread count, and that'll start to reverse. Now, we had a question on Canada, and we just wanted to use this on a seasonal chart because there's what's called the spring breakup, where you use the frozen land to essentially break down your equipment and get it away from some of these areas that are going to be flooded. You're not going to be able to move heavy machinery because you're going to get floods, soft ground. So typically then as you start coming into June, you get that acceleration point where a lot of this work comes back after the flood waters have receded, things have firmed up, and then you can get back to work, and you can see that accelerate into really through November, and then you get your decline coming into for the holiday, and then you pick it back up as everything comes back, and then you slow things back down as you come into that into that period. So when we look at things I finally killed the fly that was flying around. So now that you can see the shift, this is just a seasonal, seasonally speaking, very normal, nothing crazy one way or the other, and we don't see too much changing along those lines. Now, when we just give an update on some of the Chinese storage, here you can see that Shandong continues to be at elevated levels. As we've talked about, there's been an increase in the amount of crude that has been pulled in, but it's still very normal, and it's along seasonal normal lines, and that's what we continue to expect going into China, where we're not seeing any big surge. We're seeing very steady buying that is actually being carried out through October. So right now we're starting to see September and October movements, because remember, just because it's not posted doesn't mean that it isn't already happening. India picked up another 2 million barrels for August and September deliveries. So you're starting to see some more movement, but it's very much on a normal level. And remember, there is more OPEC production coming through, which, as we've been talking about, is you're starting to see some creep in floating storage across the Middle East. And then the other side, so Iraq actually tried to post some SOMO flows, and there was actually no bidder. And that's something that is fairly rare in terms of, one, those cargoes actually being available, but then two, once they do become available, people try to snap them up because they're typically in high demand. And we're just not seeing that, which again speaks to some of the softness on the physical side. Now, when we look at fuel oil stocks, you can see that there was a big spike in what's happened in the teapot refiners or the independent refiners. There's a lot of fuel oil that's being stored. This will either end up getting recracked or exported, because remember, there's those adjustments for what can be moved around. And that's going to be an interesting one to watch to see how it develops. What do we see over the next few weeks? So that's when we turn towards what's happening in China. What are some of the imports doing? Because we have seen some new cargoes get purchased. And this is when we turn to, okay, what is seasonally normal? And you can see that we're right back to kind of that seasonal norm for what's moving through. And as we've been talking about, there's been some purchases, but ESPO is starting to come down a bit, and we're watching that come down at about 20-cent increments from the premiums it's been at. We've talked about how Dubai still remains cheap versus Brent and WTI, but it's also cheap versus West Africa. And that makes sense in terms of where we're seeing some of those discounts out of West Africa, and it's still very slow to clear. We're already into the end of July, and there's still a lot waiting to move through the system. But then on the other side, as we said with Iraq, that cargo just is sitting around, which leads to what are we going to see in floating storage in the Middle East and in some of these other regions, because we have seen some of this go mobile. This is going to show up as crude in transit instead of crude in storage. So we're going to want to see how is this adjusting based on when we turn to what some of the independent rates are doing. So you can see that there was a dip in refinery run rates out of the independents. It was a mixture of two different things. One, there was some downtime for some turnarounds. and there's just a little bit of a slowdown in terms of activity. The SOEs have already rolled back a bit, but obviously, as we talked about in the econ show yesterday, a lot of flooding, a lot of impacts to that flooding, and these are just some of those pieces carrying out where you're just not going to see the same type of demand. So that's going to also be something to watch as we turn to storage. So we had some draws out of Singapore, and it was in the middle distillate and light distillate side. So the light distillate, you can see that it was fairly small. We expect to see that come back up. But when we turn to what's coming into Europe, there was another sale. There was actually another VLCC that was loaded that's signaling to, heading into Europe with gas oil. So here's where that timing delay is in terms of when did things get released from Singapore and when do we see some of that backstop. There were some restrictions and mobility reductions in Asia that were announced again, especially in Vietnam. So all of those things are just going to limit the amount of light distillate that is going to be demanded. So we expect to see middle and light distillate pick back up. Residual, it actually had a fairly large build. That's not something, that's again more timing delays in terms of the capacity moving around. Where we want to look the most is going to be middle and light distillate, because that's where we think we're going to start to see some of those builds in general over the next few weeks. And here, when we look at what's happening in Europe, you can see that gas oil had another drop down, and again, there's 3 cargoes that should be there this week. There's another 2 behind it with another one just loaded. So there's going to be a steady flow of product coming in on the gas oil side. Fuel oil should continue to get whittled down. Naphtha it's still an open season for exports from the U.S. into Europe. So naphtha should stay fairly stable just because demand is there to offset what's going to come in from the U.S. And then gasoline, we're going to start to see some steady builds just based on, some slowing demand because of COVID, because of floods. And then we have a little bit of a pullback in just the amount of exports that we're going to see over the next 2 weeks. So then when we turn to the activities in the U.S., so this is just looking before July 4th, because we just want to look at, what is that total? So you can see the total had a steady move down. When we look at, where the drawdowns are coming from, you can see we're still not getting the amount we would like from the pandemic and pandemic emergency, but that will accelerate as a lot of these programs expire. As the programs expire, that will then speed through the amount these are pulled off. But we did get an increase in the unemployment claims and the continuing claims for yesterday. So we're back over 400,000. And we did see some slowdowns on the service side. So I think, as we were talking about coming into July, our view was that we got a big bump, and then we were going to see some smaller moves and things that were going to be a little bit on the softer side, because when you look at restaurants, when you look at a lot of these different entities, wages, people cost more. So they're trying to do more with less. And now that we still have those residual issues in the supply chain, some of those slowdowns, you're having, let's just say that if a assembly line can operate 24 hours a day or 12 hours a day, they're starting to shave some of those days, some of those hours down. And that's either cutting a full shift or, providing essentially, 3/4 time to each shift and just reducing in general, trying to protect against that. And you just don't need the same amount of people. So that's where we're seeing some of this residual unemployment. This is the problem when we look at what is future demand going to look like when we're talking about oil, gasoline, and other, as we continue to see some of the softness on the unemployment side, continuing unemployment side. But then when we turn, and in the econ show next week, we'll talk about it, people are starting to get a little bit more concerned about their jobs, a little bit more concerned about going out, which is just hindering, I think, some of that demand as we go through August and into September. And that's when we start turning to, what are the data sets coming out for just recently with PMI. So when you look at PMI, manufacturing side, you had a nice beat. It was expected at 62, came in at 63.1. But services was expected at 64.5 and came in at 59.8. Now, it's still expansionary, but so it's not that it's a really detrimental thing. It's just it was a big miss to estimates, and you're starting to see that roll over. Now, it's more along the lines of what is driving it in terms of some of the different pieces, where input prices fell to 72.1 from versus 74.2 in June. So it's still the 14th month of expansion, but again, you're starting to see some of that cap out. But employment falls versus prior month, and it's the lowest reading since March of 2021. So that's where when you look at the service side, and we come, then all of a sudden you look at the services and you say, okay, well, that's a miss. You have employment falling versus prior month, and then you start looking at, well, then you had unemployment pickup, you had continuing claims pickup, and you start to see where we're getting to this plateau, if you will, which is what we were talking about when we've been talking about jobs, that you were going to get this big snapback, then you were going to get this steady grind. But the slope, I think people have been very aggressive on the slope and or pace of recovery when you're looking at jobs, and we're just not seeing it to that level. And we're going to do more. We're actually going to have a whole section on that next week in the Econ Show. Now, on the composite side, it fell to 59.7. Employment fell from 54.3 to 53.8. So again, just to give you an idea of just how much that drop was. And then when we look at new orders, they fell to the lowest reading since March 2021. And I'm sorry, new orders fell to the versus the prior month, and it's because backlogs continue to grow. Speaking to issues of the supply chain, trying to manage that, which is then carrying out in employment as well. On the manufacturing side, input prices rose to 86.4 versus 82.8 in June, which is the highest reading since the series began. And unemployment rose versus the prior month, highest reading since April 2021. So this is where we're getting some of this capacity, because some of the and when I say the assembly lines, when we also follow the different Fed reserves and the banks, and because they each one will put out their own PMI, their own breakdown, and some are showing this slowdown in employment, but an increase in work week. So you're having more employees you have less employees do more, and then in others we're seeing them both come down as these adjustments, but net you're getting a steady increase in what the expectations are. So it's on the services side that we're seeing some of that cool down, and that's really going back to bars, restaurants, hospitality, where you kind of get to this peak. What is peak summer travel season, but end of July, all of August. So if you've already pretty much hired, and now you're starting to see some of these movements in between. This was just from earlier when we look at some of the driving activities, and you can see that Europe has really rolled over. And this is a mixture of COVID, this is a mixture of floods, this is a mixture of just some of these new restrictions or some restrictions in there. And then you can see that rest of Asia is actually rolling over again a bit with the Americas, just because there's the COVID issues in Latin America, in Asia, there's additional lockdowns. Europe, you're not seeing, as we said on Wednesday in segment 1, even though we're seeing case counts increase, we're not seeing the same type of residual increase in hospitalizations, which is a positive, but it still doesn't mean that people aren't going to try to adjust and avoid some of their exposures. China is continuing to struggle. This will move down again, just because, again, coming back to the floods. So, when we look at what's coming through the remainder of July into August, it's going to be a bit muted when we look at some of that gasoline demand. And then it's going to be important as we go into the end of the summer driving season, because when we look at the U.S., as we said in the EIA show, we expect to see this week be fairly strong versus last week when we're looking at gasoline demand. But that's not something that we think is going to continue, but come down to a little bit of a, let's call it 9.3 million barrels a day of demand versus what we expect to be about 9.5 this week. And then rounding it out, when we look at the costs within Europe. So one of the things that we keep talking about is when we look at prices. So we talked about in the U.S., Procter & Gamble, Kimberly. But then when we look into Europe, among some of the people that have announced, Unilever said that because of all their expenses, they're increasing the pricing for everything from bouillon cubes to hand sanitizer. So everything in between. And then when you look at Dutch paint maker, Akzo Nobel, which supplies Apple, BMW, it's already hiked their prices by 4.5% and is planning to increase more by the end of the year. So this is just when you look at what's happening within Europe. Even though we're seeing some of this support for pricing, that you're starting to see it balance out. You're starting to see the input prices flatline, but we're just not seeing them come down. And now we're starting to see that roll down to the consumer. Again, speaking to what is demand going to be as wages continue to fall, specifically in Europe, as we talked about 2 weeks ago. And with that wage compression is happening while these prices are going up. But when we think about prices, they're still not going up as fast as the U.S. And just based on what we saw with the PMI, the flash PMI numbers, there's some that are still going up. There's some that are slowing down. So net, they're just not going up as much, but they're able to hold this elevated level, which again, when you marry that with what's happening with wages, what's happening with costs, this is that what is the activity? Who's going to be able to spend the discretionary income, which is something we always look at when we're trying to talk about demand and kind of project what that demand is going to look like throughout the remainder of 2021 for the most part. But we'll always cover that in way more detail in the EIA show, and then try to put a macro geopolitical backdrop to it in the econ show. So thanks again for watching. Hopefully you have a great weekend, a lot of fun things planned. I need a haircut. That will definitely be happening. But otherwise, it's pretty low-key for me. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.